What if I told you the loudest message at the BRICS summit in Rio wasn't in the speeches, but in the silence after? An unspoken signal that the age of dollar dominance is fading. 5 continents just sketched a new financial map, and almost no one in Washington seems ready for it. Take a breath, refill that mug. Today's story isn't really about Brazil, Russia, India, China, or South Africa. It's about leverage, how emerging nations plan to steer global money flows, and how that shift could rattle your portfolio, your mortgage rate, and the entire Western playbook. We'll trace BRICS' journey from Bandung 55 to Rio 25, unpack Anwar Ibrahim's and Cyril Ramaphosa's blueprints, and flag the trades smart money is stalking right now. 17 years ago, the West froze at Lehman's collapse. Yet while Wall Street battled a credit inferno, the global South watched and learned. They saw the IMF dictate austerity, the World Bank set loan terms, and the UN Security Council veto reforms. Power looked monolithic until it wasn't. Fast forward. In Rio, Malaysia's Anwar Ibrahim called BRICS a Bandung with balance sheets. Translation: solidarity now comes with steel mills, chip fabs, and sovereign wealth. The rhetoric of dignity has morphed into rail corridors, fiber optic cables, and ringgit-settled crude contracts. He wasn't alone. South Africa's Ramaphosa blasted the UN Security Council for running an 80-year-old operating system on a 21st century network. Too rigid, too narrow, too blind to multipolar reality. Reform, he said, is no longer optional. Here's the hinge. BRICS now settles roughly 7% of intra-block trade in local currency. That sounds tiny until you realize it doubled in 2 years. At 20%, rating agencies will tweak sovereign models. At 30%, dollar funding costs lift. At 40%, the greenback stops being the only lifeboat in rough seas. Take ASEAN's local currency settlement plan. A ringgit rupiah oil invoice once looked like a novelty. Today, it's a template. Indonesia's Pertamina just inked a $500 million refinery upgrade, financed in rupiah and renminbi through the BRICS New Development Bank. No SWIFT, no Fed swap line. Business, youth, and civil society filled the Rio halls. Exactly the coalition Bandung lacked in 1955. Back then, the delegates brought moral fire but empty treasuries. Now they bring export hubs, AI labs, and a demographic wave hungry for credit not denominated in dollars. What happens when you blend political will with balance sheet heft? Institutions bend. The IMF quota formula, already under review, will face louder demands for reweighting. The World Bank's lending menu is flirting with yuan tranches. SWIFT traffic shows a slowly rising share for CNY and INR. That curve steepens each time BRICS widens its swap lines. Investor angle: local currency EM bonds in Brazil and South Africa still offer 200 to 300 basis points over comparable U.S. treasuries. If the dollar weakens on reserve diversification, those coupons become even tastier in real terms. Commodities are next. Imagine Zambian copper invoiced in rand, Brazilian soybeans hedged in rupees, or Russian crude benchmarked in a BRICS basket. Supply chains realign, and with them the pricing power once anchored to Brent, WTI or LME rules. Tech follows money. India teams with South Africa on AI ethics. Brazil links its 5G rollout to Chinese hardware with Kenyan firmware updates. A distributed innovation web rises, thinning Silicon Valley's moat. Case study: a Johor coffee exporter recently financed shipments to Jakarta in ringgit via Malaysia's Do It Now rails. Settled in hours, no dollar leg, no correspondent bank drag. Scale that across textiles, palm oil, rare earths, and the credit premium once paid in Fed funds erodes. Winners? Regional lenders sitting on local currency sovereign paper. Fintech gateways that clear cross-border retail flows, and miners linked to strategic minerals. Losers? U.S. mortgage investors who rely on offshore demand for agency MBS. American corporates that fund global supply chains in dollars, and any portfolio overweight greenback price fixed income without a commodity hedge. Keep an eye on USD per BRL, USD per ZAR, and USD per INR. Sustained weakness. There can front-run a rotation out of U.S. assets. Watch gold. Still the oldest insurance against reserve currency turbulence. And consider modest stakes in inflation-linked EM bonds. Global funds already notice. Norway's sovereign fund nudged its EM debt share to 12%. Abu Dhabi's ADQ launched a $10 billion BRICS infrastructure pool. As allocation models migrate, capital deserts old safe havens. History's rhythm never changes. Britain sold off rail bonds to keep empire breathing. America floated Fannie and Freddie. Now BRICS nations are selling an alternative to dollar rule, a lattice of regional currencies and shared credit lines. If this resonated, share it with anyone still convinced reserve currency status lasts forever. Drop a comment. Which trade do you see gaining most from a world of many monies? And subscribe for weekly contrarian briefings you won't get on mainstream feeds. History rhymes, power rebrands, stay inquisitive.